Today I'm going to be telling you the story of how I bought Workhorse at $16 in the summer of 2020. I sold it at $9 after the USPS decision was made, but I still came away with $900 of profit. And you're probably thinking, what the hell kind of voodoo witchcraft is this guy on? So let me teach you. Welcome back to Everything Options. My name is Greg, and today I'm going to be teaching you the strategy that I use to make a profit off of Workhorse, even though the share price fell from $16 to $9 at the time that I bought and at the time that I sold it. So to break this video down for you, first I'm going to talk about what got me into Workhorse to begin with, because I do want to give a little backstory on buying into the stock. Then I'm going to teach you the actual strategy that I used, and finally at the end of this video, I'm going to give you a few stocks that you might want to use a strategy on. But before we get into it, if you like this sort of video, you want me to put out more content similar to this, make sure to leave a like down below and comment what you want to see next. So, what got me into Workhorse to begin with? Well, it was the summer of 2020 and pretty much every electric vehicle stock that you could think of, pretty much all of them were going up in tandem. It was Workhorse, even Nikola was going up in June of 2020. But what really intrigued me about Workhorse is they were targeting a very specific niche. So I didn't think that they were going to be like the next Tesla of last mile deliveries. I think that's kind of silly thinking to really compare them, such a small company, to Tesla. But I thought since they're approaching such a pretty small niche, they have a good chance at success. But obviously that wasn't the case, and kind of regretted it at this point, but I still made around $900 of profit from using this strategy. And what really got me about Workhorse, what really hooked me, I should say, was the USPS deal and the promise that, they were actually going to get this deal. And it seemed very promising at the time because this was coined the next generation delivery vehicle from the USPS themselves. So I made this assumption that the next generation of delivery vehicles should probably equal electric vehicles. Well, that wasn't really the case for the USPS. Instead, they decided to go with an old diesel truck made by Ford, and the body was made by Oshkosh. So not really sure how that is next generation, but that's the USPS for you. So obviously here, Workhorse didn't get the deal. Their stock fell dramatically, all the way from probably about, $25, $30, all the way to about $12 in a matter of just 2 days. And honestly, I almost panic sold out of my position, but then I realized, well, if the stock is experiencing really high volatility, then this is actually a really good time to be selling options against it, because you're going to be capturing all that implied volatility profit, right? So that is what I did with the strategy. I was selling options against Workhorse. Every time it would go up, I would sell a call option, and from this, I was able to make about $450 in just about a month after the USPS decision was made. And then finally, I got called away, assigned on a short call option to sell 100 shares of Workhorse at $9. And to start the strategy out, I sold a $15 put expiring 7/31/2020, and I originally sold this on July 24th. So just about a week before the expiration date. So at this point, I was selling weekly options, and later on I switched to monthly options, but we'll talk about that later. And before we get into our next trade in the strategy, if you want to see what options I'm trading in real time, I post my trade alerts to my premium Discord. You can find that at my Patreon, which is going to be linked down in the pinned comment below. I also hold live trading sessions. There's a lot going on over there, so you'll definitely want to go check that out. I first sold this 15 put for $79 of premium, and then I was able to buy this option back just about a week later, right before the expiration for this, for just $8. So from this, I made $71 of profit in my very first trade. So this is what really got me hooked into selling premiums on Workhorse. And then the next trade that I had made, I sold another 15 put expiring 8/7, and I sold this for $78 premium. I bought it back 2 days later for $15 for $63 of profit, which again, pretty good. So I continued to sell put options on Workhorse. And then this one is where it kind of flipped the script. So I sold this $16 put on Workhorse expiring at 8/14/2020 for $120 of profit that I ended up keeping because Workhorse was actually trading below my strike price on my expiration date. So I bought 100 shares of Workhorse at $16 with this trade. So if anyone is keeping track here, so far I've made about $254 of premium from selling options against Workhorse and buying them back. This one obviously I didn't buy back, but I didn't stop there, obviously. If you look at my history, I sold a 17 call expiring 8/21. I sold this on August 18th, so it only had 3 days until expiration, which you really want to set the expiration date a little bit further out, but because Workhorse was pretty volatile and going up pretty significantly at this time, I was still able to get $70 of premium for $1,600 because I originally bought these for $16 each. But I got $70 to sell this call option, and then I was able to buy this back a few days later for just $5. So from this trade, I made $65 of profit. And then again, since I didn't get assigned to sell 100 shares of $17 because of this call option, I sold an $18 call on August 25th, expiring 8/28 for $70. And this one, again, I basically made the same trade that I had made before, but with a different strike price, different expiration date. I bought it back for $5 for another $65 of profit. And I continued to pay this off by continuing to sell call options against my 100 shares. I sold this 19 call expiring 9/4 for $75, and then I bought this back about 4 days later, I guess, for just $10 for $65 of profit. And so I continued to use this strategy, and then Workhorse saw this huge gain the very next week to where I was able to sell a $30 call option expiring 9/11/2020 for $70 of premium. Remember, I sold this one right here, a $19 call, so $11 cheaper in terms of the strike price for around the same price. So I sold this for $75, and then I sold this 30 call for $70 of premium. And then Workhorse obviously was extremely volatile at this time, so I was able to buy this back for around $4 closer to the expiration date. I bought this back on September 10th. Expiration date was 9/11, and I bought it back for $4, so I made $66 profit from this trade. And then, it's just kind of a rinse and repeat thing. I sold this one for 101. I bought it back for 25. I sold this 35 call for 75. I was able to buy it back for 25 for $50 of profit, so a little bit less because I was kind of worried that Workhorse would continue to go up. So I bought back my call option for a little bit more premium than I usually do because I didn't want to get assigned to sell 100 shares of Workhorse at $35. I thought maybe it could go to like $40, $50. Back then I was pretty bullish on Workhorse, unlike I am today. So I continued to sell call options on Workhorse. I actually tried to sell a put option. That might have been a mistake there. But there was actually a period of time where I didn't sell any options on Workhorse. So the last trade that I had made was on October 13th, and the next trade wasn't till January 25th. So this was the whole GME craze. People probably thought that, Workhorse was getting shorted, so people are like, well, let's buy into Workhorse again. So I sold this 33 call for $98 of premium, one of the most amounts of premium that I had ever received at this point at the $33 strike price. And then I actually took a loss on this one. So I bought it back for $135. So since I bought it back for more than the credit that I originally received, I actually took a $37 loss in this case. And honestly, looking back on this, I could have made more profit had I sold it at $33. I would have been up by as much as $1,700 in appreciation of the shares, and I had made about $641 of profit from selling options. So at this point, I would have been up by as much as $2,300, but I was still pretty bullish on Workhorse. The USPS decision was yet to be made at this point. So, I bought this back so I didn't get called away on my shares. Then I sold this call option. Now for $270, this is the most amount of premium I had ever received, and this is because I stretched my expiration date out. I sold this on February 17th. The expiration date was 3/19, So I got a lot more premium by selling this option than I was through the weekly options that I was using before. And this is why now I like to set my expiration date for selling options to about 30 to 45 days out. And yes, it does incur more risk since there's a little bit more blur when it comes to the share price over a longer period of time versus weekly options, but at the same time, $270 is a lot. So I sold this for $270. I bought it back a week later for $98. So this was $172 of profit from just a single trade that I had made in a week. And so I continued to sell call options against Workhorse, against my 100 shares. I sold this 22 call, so it had dropped at this point. I was selling the 40 calls before, now I'm selling the 22 calls, so dropped pretty significantly after the GME craze. And I sold this for $225. I bought it back for $120 for $105 profit here. And then, of course, I continued to sell call options against Workhorse. I sold this one for $300. I bought it back for $165 for about $135 of profit there. This was a 24 call, so it was probably trading around $20 to $22 at the time. And then I sold this 19 call for $284. I bought it back for $195. So at this point, Workhorse was really starting to come down pretty significantly from the $40 call options that I was selling before to now selling $19 call options. And then I continued to sell Workhorse call options. This one I sold for $132. I bought it back for $95. So the premiums that I was able to get out of these trades was coming down pretty significantly because Workhorse really wasn't as volatile as it was, whenever I was receiving $270, $300 a premium for selling my options. So it is a little bit disappointing whenever the volatility does drop, but that is something that you need to be aware of because volatility is never really constant, right? So I sold a 18 call now on expiring 3/19. And I switched back to the weekly options. I sold this for $113. I bought it back for $61 for $52 of profit here. And then I sold this 20 call for $189. I was able to buy it back for about half the price at $98. I sold this 18 call for $128. Bought it back for $67. I sold this 14 call. So this is the point where USPS finally made their decision, and well, Workhorse kind of went in the crapper here. It went all the way from $18 I was selling call options before to now a $14 strike price. And also this is getting a lot less premium because the share price is continuing to go down. Usually the premiums that you're receiving is going to be in accordance to some degree with the share price. So at this point I was getting $46 of premium for selling this 14 call. I bought it back for $12 for about $34 of profit. So definitely significantly less profit that I'm receiving at this point. And then I sold a 1150 call, so Workhorse was really down to the dumps at this point, for $39. I bought it back for $15, so made about $24 of profit here. And then finally, this is the very last trade that I made on Workhorse. I sold this $9 call option expiring 6/18 for $65 of profit. At this point, I just wanted to get out of Workhorse no matter really what it took. I really wasn't interested in the stock anymore. I didn't want to follow the news because it was all pretty, pessimistic, very toxic. So at this point, I decided, well, I'm just going to let this option expire in the money. I'm going to just get out of my shares at $9. So remember, I bought Workhorse at $16. I sold this at $9, but through this entire process that I've taken you through, I was able to extract about $900 of profit. And this isn't the only stock that you could really do this on. There's a plethora of stocks that see the same amount of volatility, and really, Workhorse isn't as volatile as it used to be. So let me give you some of the best stocks right now to sell premiums on. So the first thing that you need to do is find a stock that is extremely volatile. And this is kind of a caveat, it's kind of a double-edged sword, but if you can find the right stock that is volatile and it's also going in the right direction overall, if it continues to go up, you can make money both on the premiums and also the appreciation of the share price for that stock. But at the same time, you want to choose a stock that you're actually comfortable holding 100 shares of for the long term. For me, I was actually comfortable buying into Workhorse because of the USPS, and well, the decision fell through on them, but I still made a profit otherwise because I was able to continuously sell premiums as I continued to own the shares, and I was comfortable holding the shares until the USPS decision was made. Then I got out. And a good way that you can go about finding these super volatile stocks on your own is through social media, which is actually extremely important, like StockTwits or Twitter. Usually the stocks that are on these different platforms have a lot of volatility, especially the ones that are on the trending page over on StockTwits. And I know this isn't really kosher per se, and there are a few ways that you can actually be a little more meticulous about it. And a good way that you can track the volatility might be to use FinViz, using their stock screener, and then searching for a stock that is up the most or down the most on a single day. This was one of the ways that I was able to find Workhorse, and then I did a little bit more research on the company, and then I started to sell premium on it. So for me, the stocks that I'm following pretty closely that I believe to have pretty high volatility right now are Tilray, BlackBerry, and NNDM, or Nano Dimensions. All three of these stocks have really one thing in common, and that is that they're all pretty freaking volatile, in that you'll get more premium from selling options on these stocks because of the high implied volatility that goes along with our options chain. Because there's more interest, because the stock is more volatile, that means you'll receive more premium accordingly. And what you're going to do once you've chosen your stock is to first sell a put option against it. So Tilray right now is trading for around, $12, $15. So you might want to sell a put option at, say, $11, $12. That means that you're agreeing to buy 100 shares of Tilray at $11 or $12. And for that, you're going to be paid a pretty good premium. If you set your expiration date to maybe about 6 weeks out, say November 19th, it's a little bit more than 6 weeks, but you generally want to sell options with 30 to 45 days until expiration, and this is closer to the 45. So we're going to look at the put options here, and then we're going to first start by selling a put on Tilray, and right now these are going for $124. So you're getting $124 of return for putting $1,100 down. That is more than a 10% return on a monthly basis or a 45-day basis, which is really good. And again, this is because the stock is super volatile, so you will have to take on that risk of actually having to buy 100 shares of Tilray if it trades below $11 by your expiration date. So even if Tilray is trading at, say, $8 on your expiration date, you're still going to have to buy 100 shares at $11, even though the market price is $8. That's just what you sign up for whenever you're selling put options. So something to keep in mind here. For BlackBerry, on the other hand, right now it's trading for $9.70. It's down pretty harsh over the last week or so, down by 60 cents or 6%. But because it's trading down so much over the last week, you will get more premium from selling put options because of it. So we're going to set our expiration date to November 19th. Again, 45 days out, so erring on the longer dated expiration. And the $9 put option is going for $58. So you're getting less return as a percentage versus Tilray, but you're still getting a $58 return on $900 invested, which is probably about maybe 5% or so, maybe a little bit more, maybe 6 or 7%, right? And then finally, NNDM probably has some of the highest premiums because NNDM is extremely popular among options traders. So we're going to search for NNDM. We're going to pull up the option chain, go to November 19th again. So they have less expiration dates, so it is going to be a little bit more difficult to get in and out of your trades. But you're going to get $34 for $500 down, which I think is pretty good. That's about a 7% return in 45 days. But at the same time, you have to be aware that you're agreeing to buy 100 shares of NNDM at $5. Again, I want to reiterate this. If NNDM is trading below $5, it doesn't matter where the share price is. It could be as low as maybe $1 if NNDM just goes to crap. You're still going to have to buy 100 shares at $5. So this is a risk that you need to be aware of whenever you're selling put options. And on the flip side, whenever you start to sell call options, you have to be aware that you could be assigning your call option to sell your 100 shares of a stock at the strike price that you agreed upon. So what if you sold a $7.50 call on an NDM? Right now, these are going for $23. So you're not going to get a lot of premium because the share price is pretty far from $7.50, and they don't have a lot of strike prices, which kind of sucks. But at the same time, you're still getting $23 for, $5.67 as a share price if you were to buy 100 shares at the moment. But if an NDM were to go up to, say, about $15, then you would still have to sell your 100 shares at $7.50, since that's what you initially agreed to. So the share price could double from where it's at right now, or even triple, but you're still going to have to sell 100 shares at $7.50. So that is the caveat to the strategy that you absolutely need to know. That is a risk associated with it. So hopefully you learned something out of this, and if you did, make sure to leave a like down below. Thanks for making it all the way to the end of this video, and thank you to all my patrons for the support. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys.